Hello, welcome back guys. I hope you are doing well. In this video we're going to be taking a look at Apple. It's been a little while since I last took a look at the company, and from time to time I do like to revisit these well-known companies that a lot of people are interested in, because they do up, they do go down, they do go up, and we kind of need to re-examine them from time to time. Now, as usual, I'm going to be using our tool here, the one that our Patreons have access to. If you're interested, you can become a Patreon. You can find the link in the description box below this video, and you can gain full access to the tool. So, what's going on with Apple here? We can always take a look at our stock news module here, and you will see that a lot of articles are talking about Apple, Microsoft, and the likes, pretty much. Wondering about which one is the better buy over here. And it's also mentioning Warren Buffett, who is one of the proponents of Apple here and has bought a lot of it. But the question is it now the time to be buying Apple? Because it's been growing a little bit higher than what it normally is. Of course, we will examine it with our tool here and see exactly what kind of price it makes sense to be paying for this one. It's actually not down a lot at all compared to the rest of the market, especially. It's been holding strong over here, as you'll see. Just 7% down since its 1 year high. It's almost nothing compared to a lot of other companies. And you will see that the P ratio is still sitting at 28. Now, that's not too expensive. Because remember, we're talking about a company that is a behemoth here, and it is a company that is making tons of cash flow. It's a company that's buying back shares, a company that has great margins. It's overall doing fantastically well, and just paying a little bit extra, a little bit more, it may not be a bad idea. Now, how much extra, we want to see whether it actually makes any sense, or we want to be waiting for it a little bit in terms of its price going down potentially slightly. Now, if you take a look at the price to free cash flow ratio here, you will see that it's sitting at 30, which is also very close to the PE ratio. It's a good thing. That is a good thing. And it is a good thing because we, generally speaking, want profitability, that is net income, to actually give us a similar amounts of free cash flow, more or less. And so 28 and 29 is very, very healthy here. In terms of outstanding shares, it's been going down because the company is buying back shares and will keep buying back shares, which is fantastic for shareholders. So if you become a shareholder now, you're going to be getting the extra thing that the company is buying back shares. And this is a great idea, really, for a company and for the investors of this company. In terms of total liabilities that the company has, compared to the free cash flow that the company generated last year, it would take them about 3 years of last year's free cash flow to pay back all the total liabilities that the company has, which is pretty good. Generally speaking, we want something like 5, as you'll see here. The tool actually becomes a red here when the number is above 5. Okay, in terms of revenue growth, 60% for a company of Apple's size is amazing. As you can understand, the company is still growing massively, again, for its size, because we're talking a lot of billions here. And in terms of net income growth, again, growing amazingly. Same with the free cash flow growth. It's only the total equity growth that is going down, and we have talked about it. There are two things here. The fact that the company is buying back shares means that they are reducing their total equity, because when you're buying back shares, you're actually spending part of your equity, you're spending part of your cash, and you're getting back treasury stock, which is not really added back to the total assets. And so you're looking at the total equity going down here, and this is normal. And also, Apple has been getting some extra debt on purpose. This is why you're looking at debt to equity ratio that is rather high, but it's controllable. Apple is doing that on purpose because they could be getting, and they were getting, cheap debt. And so if you can fund your operations, if you can get cheap debt and actually balance it out with your earnings and basically not even pay tax, because now you have debt liabilities that balance out your earnings. Now that's a very, very good proposition for a company and great for shareholders as well. So it's fantastic. And even if you're looking at the debt to equity that's high, that's still an awesome picture for Apple if you dig a little bit deeper into what they have been doing. And I have made a dedicated video in which I'm talking about this concept and what Apple has been doing in terms of that. I will actually link to that in the end of this video if you're interested in taking a little bit of a deeper look. Now, this actually increases the return on equity as well. So when you are actually getting more debt, you are reducing equity, you are actually buying back shares, then your return on equity increases, because at the same amount of net income and less equity, now your return on equity is higher, because return on equity is what? It's like net income divided by equity, or the total equity of the company. So the dividend yield of the company that the company is paying is about 0.5%, which is about a 15 to 16% in terms of the payout ratio. Very comfortable here for the company. But we always want to be taking a little bit of a closer look at our dividend stub, see how this has been moving through the years, and the dividend yield ratio here, which is looking very, very healthy. And the company seems to be increasing it and should be able to increase it without issues for the next few years, pretty easily, actually. Now, the next thing that I want to do is kind of take a little bit of a look at the income statement. And you will see here that the revenue has been increasing tremendously. Same thing with the net income from 48 billion to 94, doubling itself pretty much, which is amazing to see. In terms of the balance sheet, you will see what I said earlier, the fact that the total equity has been going down because of what we said. The company has been buying back stock like crazy. They have been also getting some extra debt. So again, this is something that they control. They know what they're doing. This is where the total liabilities are sitting at 288 billion. And if you remember, the cash flow, the free cash flow of last year compared to the total liabilities was like 1/3 of them. So this is like 93 billion here, which is absolutely amazing. It's a lot of free cash flow to be making for a company in a year. That's absolutely insane here how much they are making. And you can always see over here that the net cash from operating activities has been at about 104 billion here. And again, remember that the net income is where it starts with, 94.6 billion, and then some stock added compensation, some stock-based compensation added back, and some adjustments here based on income taxes and change in working capital and inventory and things of that sort. Normal stuff. In terms of investing, the company has been investing about 14 billion last year. That's about 11 for capital expenditures, as you'll see here. So that's the core of it pretty much. And in terms of financing, the dividends that they're paying, they are like 14 billion, which remember is about 14%, 13 to 14% of this amount, the free cash flow that the company is generating. So very, very comfortably paying that is the thing about Apple here. Very, very easily paying that out to shareholders, that is. Now, we can always take a little bit of a look here, a little bit of a closer look at our other modules that can help give us an idea of all sorts of different things about the company. And so insider trades is an interesting one because it tells us what is happening with insiders, how much they are selling, how much they are buying. There's a lot of selling going on here, like 9 sales here and 22 in the previous 6 months. So actually less here. It's just that we don't have too many other movements pretty much. And this is normal in many situations. I mean, when you are looking at executives selling stock, this makes a lot of sense because they want to be making some money back. It's part of their compensation. So you shouldn't be too scared if you're looking at them selling. What should be kind of scary is if you are noticing weird patterns, like for example, if they have a lot of stock. So for instance, let's just say that this secretary here has like 500,000 units of stock and they sell them all, or they sell like 350,000. That would be weird because this amount is probably amassed through the years. It's not just a one-time payment. It's not like they got paid last year for this amount of stock. Now again, you kind of want to take a look at their history and see how much they have been awarded and all that, to get a sense of what is the normal selling patterns, and this is the important thing. But overall, it's gonna be easy to look and actually understand whether there is any weird pattern just by taking a look at these values here. And again, you can easily do it with our tool here. You just pretty much compare them. You can just see them in your eyes, with your eyes, and see what they are selling here and what they are doing. So you will see that there is a little bit of selling here in terms of the CFO. That's Maestri Luca here. And so what we want to do is actually we can type their name instantly, exactly, or CFO for instance, and we can kind of see what their selling patterns have been, for instance, over here. So they have been selling and they have been buying, and when we're talking buy here, these are awards. You'll see the transaction value is 0. So the company is paying them this amount here, and they're paying them like 200,000 shares. So that's a lot. And so you may be wondering, is it weird for them to be selling 100,000? And it's not really, because they're getting paid a ton. And so it makes a ton of sense to be selling like half of this. But again, if they owned a vast amount of stock, like 500,000 or so, and they sold out of all of it, that would be a little bit weird. But typically, generally speaking, when they're actually selling just a little bit, or even if they're selling the whole lot that they received last quarter, for example, that's still fine. So that's still not a big deal. And so there's nothing out of the ordinary here. The other thing that you want to be examining is purchases, which you can always see with a green, pretty much part of the bar here, which is not over here in the pie chart. And you will see that, you can always take a look at the purchases. And a purchase happens when somebody is actually spending their own money to be buying stock. And this is especially if it happens from one of the executives, is indicative of things going well for the company potentially. So you need to be taking a look at these two things. Now, in terms of senators, which we also can take a look at over here, you'll see there has been a little bit of a sale here in terms of Josh Gottheimer here, who has sold a little bit. These are small sales again. The way they file these, they have to be arranged, so it's like from 1,000 to 15,000, which obviously it's not a lot for a senator here. But last 6 months there have been purchases as well, when the price was even lower, remember? So when the price was even lower, we would be seeing some purchases as well, like over here, and quite a lot of it. Like Nancy Pelosi has actually bought a lot of Apple here, as you'll see. And they transacted back in May, pretty much. They published it in June. Very interesting to see this one. Okay, the next thing and the final one that we're going to be doing for our analysis here is a stock evaluation tool. We're going to discover what price to pay for the company, what price to pay for the stock. And again, we can do that easily with our tool here, just by using our projections tool. And you will see that the revenue growth of the company has been 11 for the 5 years, 12 for the 3 years, and last year they did 33%. And so the growth has been a ton, has been amazing. We're going to be using something that's less than this, like the average is 11. I'm going to go in between in this tool, in this session here. So I'm going to go 9, 11, and 13, which may be a little bit too much, but let's just see what we're getting out of this one, because remember that we're buying a company like Apple. It has been doing amazingly well. So paying a little bit more, or having our projections a little bit adjusted to a little bit of a higher pattern, it's not a huge deal really, as long as we can still get a solid price. In terms of the net income margins of the company, they're sitting at about 20 to 25. So again, I'm going to go in between 20, 23, 25. In terms of the free cash flow margins, a thing that I love to see, all of them are like, as you see, solid here. They're streamlined. They're almost 100 to 120. So pretty amazing here to see for the company. I'm going to go 95, 105, and 115 is what I'm pretty much taking a look at here. The average is 110 actually. So this could even be 110, frankly. Now, in terms of the annual return, I'm going to be asking for 13%. I can get like 10 out of an ETF, like an S&P 500 one. So I need to be getting a little bit more here. There's more risk in single stocks. And we hit calculate. Let's see what we're getting out of this one. And when we hit calculate, you will see that we are still in the red. And our high projections, our high estimates have been at 13% of revenue growth, 25% net income margins, and 115 for the free cash flow margins here. Now, this is a little bit confident. This could happen. It's not out of the ordinary. It could happen for sure. It is a little bit more confident though, and even then we're sitting at 150 almost. And so the current price is 170. So it is expensive. And again, you may overpay a little bit to get a great company, and I totally understand that. It's generally speaking a good idea to be getting great companies, and maybe even overpaying slightly, because it's much better to get a great company at a little bit of a more expensive price and actually get a mediocre company at a great price. And so overpaying a little bit may not be such a huge deal. But in this case, I think I want a little bit of a better price, frankly. I want a little bit of a better entry point. So I could consider potentially buying at like 140, 130, but probably not near 170 here. It feels a little bit too expensive, even for a company of this sort. So I'm kind of willing to wait it out and see whether it's going to be going down a little bit and give me a better entry price, because it has happened. Like, remember, it was sitting at 140 or so, and you can take a look at the 6-month chart, almost 130, where it was a pretty nice buy over here. But right now it's actually getting a little bit more expensive. And remember, we have been quite confident as well. We have actually used net income margins that may actually shrink a little bit potentially for a little while. So yeah, something I'd say near 130, 140 would probably be a nice entry point to potentially add a little bit of Apple here, or maybe quite some actually. So thanks for watching the video, guys. Tell me what you think about Apple. Please leave a comment and let me know. And if you are not a subscriber, become one, and please like the video as well. That helps a ton. And I'll see you in the very next one, guys. Bye bye.